Hello, thank you for joining us for our quarterly investment perspective review. My name is Aldo Voltaggio and I'm the Chief Investment Officer at Capstone Financial Advisors. First, a quick market review. Stock markets broadly extended their gains during the second quarter as the risks of a regional banking crisis and debt ceiling impasse receded, all while corporate earnings broadly came in better than expected. The U.S. stock market materially outperformed the international stock market in the second quarter due to its heavier composition in information technology stocks, which have been the best performing sector so far this year. Meanwhile, the bond market faced headwinds as interest rates climbed further. The U.S. bond market declined slightly for the quarter, while the international bond market edged out a slightly positive return despite increases in global interest rates. Year to date, through the end of June, both stock and bond markets are still positive, and stocks are materially outperforming bonds. Looking ahead, our view is that stock markets could continue to gain, but likely at a more moderate pace relative to the first half of the year. The rationale for subdued further potential gains is that global stock markets in aggregate have rallied strongly this year and have entered bull market territory since the lows of October of 2022. The markets are up more than 20% since then. And together with declining earnings growth, aggregate stock market valuations, as measured by price to earnings ratios, have increased significantly, also up around 20%. However, as mentioned earlier, the stock market rally and ensuing higher valuations have been fairly concentrated in large cap technology sector stocks that suffered the worst declines last year. As such, stock market gains could continue as the rally broadens to include more companies and sectors, particularly those that are profitable, have healthy balance sheets, and are the most undervalued. With regard to the outlook for bonds, we think bond market returns are likely to stay positive, despite continued uncertainty around future interest rate increases. Bond markets could experience declines if central banks communicate more future rate hikes than is currently expected. However, declines would likely be limited and short-lived, as most central banks are closer to the end of their rate hiking plans. Notwithstanding near-term policy uncertainty, bond markets will likely deliver higher positive long-term returns going forward. First, better bond market performance is primarily driven by higher starting yields that investors can currently earn on high-quality bonds. Yields are in the 4.5% to 5.5% range, as you can see here. The significant rise in interest rates since early 2022 has presented an opportunity for long-term investors to earn higher income across high-quality bond sectors. Secondly, because the economy is likely to continue slowing and possibly enter a recession at some point, central banks will inevitably start to cut rates, which would result in material price appreciation of intermediate and long-term bonds. On the economic front, the U.S. economy has proven to be more resilient in the first half of 2023 than many expected. Continued strength in the labor market has helped support consumer spending, which is the primary driver of U.S. economic growth. Despite a strong economy overall, core inflation has been decelerating in the U.S. Core good prices, that is, excluding food and energy, have declined rapidly this year. Rent prices, or shelter, which is the stickiest and most significant contributor to the consumer price index, peaked at the start of the year and has started declining. Service prices, excluding shelter, considered the most wage sensitive, has also started declining. As such, the Fed appears to be, so far, successfully taming inflation without inducing a recession. Looking abroad, Europe's economy has also been surprisingly resilient, despite the European Central Bank and Bank of England continuing to raise interest rates amid persistent inflation. Although the euro area technically entered a recession following modest declines in gross domestic product in the first quarter of 2023 and the fourth quarter of 2022, there has been little evidence of a sharp economic downturn. Moreover, leading economic indicators suggest that euro area likely resumed growth in the second quarter amid European consumer demand, which has held up better than anticipated amid continued low unemployment and growing wages. Meanwhile, China's economic recovery lost steam in the second quarter after a strong first quarter driven by the economy's reopening after COVID-19 related lockdowns. Economic activity has weakened recently across both manufacturing and service sectors. Moreover, continued geopolitical tensions have kept a cloud of uncertainty over the region. Good news is that inflation has been subdued in China, while enabling the People's Bank of China to lower lending rates for consumers and businesses to stimulate the economy. Looking ahead, the near-term outlook for the U.S. economy is generally positive entering the second half of 2023. However, consumer demand, business investment, and job growth momentum will likely slow as the lagged effects of all the prior interest rate hikes continue to set in. If the U.S. economy maintains its current course of a gradual slowdown, a recession would likely occur further out in the future, maybe sometime in 2024 instead of 2023. Moreover, a recession would likely be relatively short and shallow, given the strength of the economy and the relatively strong financial shape of most households and businesses. Inflation in the U.S. will likely continue to moderate. Shelter inflation, that is, rent growth, is expected to continue declining throughout the second half of 2023, while slowing momentum in the labor market should also gradually lower broader services inflation, mainly wage growth. Moreover, despite improvements in the inflation picture thus far, the Fed will likely stick to its commitment of bringing inflation down to 2% and keeping it there. As such, the Fed will likely hike rates by 0.25% at least one more time this year and keep rates where they are well into next year. Economies abroad are likely to remain challenged in the near term. Similar to expectations for interest rate policy in the US, the European Central Bank and Bank of England will likely continue raising interest rates in the year's second half by another 0.25% to 0.5%. Given the growth dampening effects of higher rates, Europeans' economic growth prospects will remain challenging. However, higher rates should further dampen inflationary pressures in Europe. Lower inflation should strengthen consumer confidence amid continued low unemployment and solid wage growth across the region. In China, recent economic data indicate slower growth may be coming in the second half of the year. However, weaker economic data may prompt Chinese policy leaders to introduce additional stimulus measures. These measures could include lowering taxes on companies and further cutting lending rates for consumers. Moreover, to meaningfully spur economic growth, China will need to improved business and household confidence, which has been negatively impacted by a declining real estate market, high youth unemployment, and lingering anxiety about COVID-19 policies. However, sentiment should gradually improve over time. Recently, the world of artificial intelligence has been propelled into the spotlight by a groundbreaking program known as ChatGPT, launched in 2022. This innovative leap has shone a spotlight on generative AI and its potential implications, particularly in the realm of investments. Many are interested in how the prospects of AI may be boosting stock market performance, particularly for a handful of the largest technology companies. It's important to note that the recent exceptional performance of prominent tech giants isn't solely attributed to AI's future prospects. Their remarkable success so far this year has been underpinned by robust sales and earnings growth, a lot of which has not been directly tied to AI. But the AI narrative takes an interesting turn as we look ahead. The fact is, the world's leading technology companies are strategically positioned to harness the adoption of generative AI. Cloud computing services and semiconductor enterprises are set to be pivotal in constructing the infrastructure for AI model development and managing the surge in data processing demands. However, drawing from history, we have witnessed a pattern of technology trends echoing across a multitude of companies in various industries. Generative AI, too, promises to be pervasive. As the application ecosystem flourishes, new software companies are projected to emerge, and existing smaller software companies may rise to prominence, similar to the tech revolutions of the past. Further, venturing beyond the software and technology landscape, the impact of AI will extend to many other types of companies. Sectors like healthcare, education, financial services, and consumer goods stand to reap the benefits of AI-driven efficiency, enhanced services, and increased profitability. In summary, the path for generative AI is a journey still in its infancy. A multitude of companies, many of which currently don't exist or are not even technology companies, will undoubtedly ride the wave of AI's expansion. However, as the future remains uncertain, wise investors should adopt a prudent strategy. Rather than fixating on predicting and picking winners in this transformative landscape, a diversified investment portfolio spanning various industries, company sizes, business lifestyle stages offers a much better chance of improving portfolio returns. This approach maximizes the potential to capitalize on AI's evolution while minimizing the risks with uncertain outcomes. Our current portfolio recommendations stem from two main factors: the potential for a wider stock market recovery as interest rate hikes near their end and high rates endure, and the implications of slower economic growth leading to higher market volatility. Despite a limited number of stocks participating in this year's rally, we recommend diversifying stock allocations across many sectors, company sizes, and countries. This safeguards against the few recently best performing stocks facing challenges and positions for broader market gains going forward. We also suggest a defensive slant in stock allocations, favoring profitable, high cash flow firms that are reasonably priced. These companies can thrive in the next few years amid higher interest rates. With regard to bonds, we recommend prioritizing high-quality investment-grade bonds due to the likelihood of tougher economic conditions ahead. These bonds from low default risk entities are more likely to provide stability in a portfolio as the economy slows, and their current higher income yields, like we mentioned in the market outlook video, provides a buffer amid potential stock downturns. Post a significant market upswing, like we've experienced this year, especially since mid-October of 2022, the urge to adjust portfolios might arise. However, decisions should align with financial plans and life circumstances, not recent market moves. Regular portfolio reviews are essential to match long-term goals. We constantly evaluate client portfolios, ensuring alignment with target allocations and adjusting as needed. Periodic reviews with clients also confirm strategic alignment, a key to lasting financial success regardless of recent market trends. Thanks for watching. For more information on this topic, click the link in the description below.